Institutional allocations to real estate, commercial real estate debt delinquency rates, and CRE property disconnects. That's what I'm watching this month. Welcome to the second edition of the Real Estate Reel from Cohen & Steers for the month of October, where we provide 3 insights on real estate investing in 3 minutes each month. First, institutional investors increased their allocations to real estate in the first half of 2023, with an average increased allocation of 76 basis points. That's based upon data from CRE. Sovereign wealth funds increased their allocations to real estate for the first time in 4 years. Public pension allocations are 100 basis points higher than they were 1 year ago and are now the highest allocation at 10.6%. We see a backdrop where large institutional investors continue buying real estate to meet their allocation targets. This is a positive for real estate prices in aggregate. As you can see in this chart, almost 40% of institutional investors remain underallocated to real estate, while 36% were overallocated and 26% were at target. This time last year, the discussions focused on the fact that investors were overallocated to real estate. The second data point I'm watching, commercial real estate debt delinquency rates. 3 out of 4 lenders saw a quarter-over-quarter rise in the delinquency in 2Q of 23, according to the Mortgage Bankers Association. However, absolute delinquencies remain relatively low. That may surprise some people, so let's dig into that a little bit more. Diving deeper into the commercial mortgage-backed security market, also known as CMBS, an average of 77% of the loans set to mature each month over the last 12 months actually were paid off at or before their maturity date. This underscores our view that the entirety of the commercial mortgage market may be underlevered. While we expect higher delinquencies as the stress is building, we believe the headwinds facing the CRE debt markets will be a slow burn over a longer period of time, rather than the collapse that was feared in March. The listed markets may be sending a similar signal, as commercial mortgage REITs are the 3rd best performing listed REIT subsector year to date, with returns of approximately 7% as of the end of September. Finally, we are watching divergent paths in CRE prices across property types and leverage. Green Street estimates CRE valuations are down more than 16% as of August. The NCREIF Odyssey Index shows a decline of more than 10% as of 2Q23. We previously stated that we expect the cumulative peak-to-trough correction of 25% over the next year to year and a half. 2 points underlying this data are even more interesting to us. First, the NCREIF Leverage Return Index shows total returns are down 14% or so, given loan-to-values of almost 45%. This is important because it illustrates the impact leverage can have on valuations. Second, there are wide variations in how much levered returns are down by sector. On one hand, as we can see in this chart, shopping centers are down only around 3.6%. On the other hand, office has dropped almost 30%. Apartments are in the middle, having dropped around 13% or so. The outperformance of shopping centers is worth monitoring given many institutional investors are underallocated to this property type. Our private real estate team is especially intrigued by the opportunities they are starting to see in grocery-anchored or necessity-driven shopping centers, especially in the Sun Belt. Overall, we continue to see pressure for the private real estate market as the market adjusts to the old normal of higher rates and higher inflation. Some sectors are better positioned than others. One final point. While listed REITs have faced headwinds over the past 2 months in line with historical seasonality that's exacerbated by macro uncertainty, we maintain this offers an attractive entry point. Subscribe to the Real Estate Reel via the link on the screen and tune in next month to see what we're watching next.